next story, Financing Failure. This is the title of a forthcoming book from our guest, Vern McKinley. Vern, thanks for being here.
Great to be here. Thanks for having me.
Now, you have worked at the Fed, the Treasury, the FDIC. You've been a bank examiner, a financial analyst at the old Resolution Trust Corporation. You've been looking at the history of the financial crisis since 2008, and I think one of the most interesting things about the book, it's out in a few months, Financing Failure, is you talk about how people look at the 2008 crisis as unprecedented. We've never seen anything like this before, and Secretary Paulson, you note in the book, then Treasury Secretary Hank Paulson, mentioned that we don't have a playbook for dealing with this. But what you found, not just through your experience, but looking further back in history, is this is actually something we've seen over and over again in financial regulation.
Yeah, that's right. Each of the crises that I traced, the 30s, the 80s, and 2000s, you get this eerie sense of deja vu of the same thing happening all over again. Just as one example, your standard situation is a big bank gets close to failure. First of all, the regulators are in denial. They say, well, that can't be. That happened in all three crises. Bank of United States in the 30s, Continental in the 80s, and of course with numerous of the big banks during the most recent crisis. So the next step after that is they finally figure out that, yeah, there's a problem here, and then they panic. And they also start to tell stories, little Chicken Little stories about all the failures that are going to happen. Again, that happened in the 30s and the 80s and the most recent crisis. That's just one example of a lot of examples of this repeating of history.
Well, and a lot of the fear in this last crisis especially, it was around, they would offer terms like contagion, systemic risk, obviously, never really defined. And you've been trying to get documents out of various federal agencies to say in looking at these different rescue attempts, what does contagion mean? What is systemic risk? Let's look at the math. Have you been able to get a mathematical argument as opposed to kind of a psychological argument that they had to rescue an institution?
With the help of Judicial Watch, which is a legal advocacy group that's working with me, they're specialists in freedom of information. I've tried to get a lot of the details from especially the Fed, the FDIC, Federal Housing Finance Agency that oversees Fannie and Freddie. And the Fed in particular uses this phrase contagion, but when you ask about the details, well, how did you come up with that idea that there was going to be a contagion? You mostly see spreadsheets with a lot of big numbers, big institutions, but no connection between those big numbers and any kind of negative fallout. So to me, it's really just a situation where they get all panicked and they're worried about something happening, but they really don't figure out what these bad things that are going to happen that they're talking about.
Now, UBS is in the news now, a big Swiss investment bank, and they're in the news for a rogue trader who lost, at their current estimate, over $2 billion, $2.3 billion on unauthorized trading. You look at an institution like that, I think the first thing that comes to mind is how can we possibly put the taxpayer safety net under trading operations? But as a former regulator, bank examiner, I mean, what do you think that tells us in terms of policy going forward?
Well, it frankly didn't surprise me when I saw about UBS. They also had a bailout, about a roughly, I think it was a $50 billion dollar bailout from the Swiss government. Right, exactly. So, I mean, that was an indication that they had poor management, that they needed to be bailed out. So it really doesn't surprise me that a couple of years later their operational risk and operational analysis has some holes in it, and that's what happened with the rogue trader there at UBS.
Now, going back to our own crisis, March of '08, the federal government bails out all of Bear Stearns' creditors and bails out partially their shareholders. They obviously saw a huge loss on their investments and didn't get as much as they wanted, but for creditors, a total bailout. A lot of us have looked at that as a point, a huge mistake, basically, because it set expectations. How do you look at Bear Stearns, and how could that have gone differently?
Well, yeah, I agree completely with that. There were a lot of adverse consequences that went along with Bear Stearns. the biggest was probably it taught all the institutions that they didn't have to prepare for failure. And as you pointed out, Peter Wallison on the Financial Crisis Inquiry Commission has pointed out, I mean, that's not a very good thing to do. And I think it would have been much better to allow Bear Stearns to fail and cleanse the system of the bad management that goes along with those kind of problems at banks.
Now, one thing, last thing, because that '08 crisis, it did present a challenge for regulators that maybe they didn't see when they let Drexel Burnham collapse in 1990, and that you had a lot of the big investment banks basically exposed to the same risks. So the argument at the time, I'm sure they thought, was if we don't save Bear, then Lehman's going to be next. Of course, it did fail later, and Morgan Stanley, Goldman, the whole lot of them, I guess, might have failed in a crisis. One, do you think there would have been kind of a domino effect? And two, is that something that would have been catastrophic, or could we have moved on if they had all gone into bankruptcy?
Well, as you point out, Bear Stearns, even with the bailout, Lehman still failed. So, I mean, it didn't fix the situation by doing what was done in Bear Stearns. But, I mean, the idea of this cascading or contagion, I think it's just wildly overstated. And I mean, I think we should just let the institutions fail. I think, based on my experience, I was in Texas during the banking crisis in the 1980s, and there 9 out of the biggest 10 banks failed throughout that crisis. But the economy bounced back. I mean, it was difficult going through that. I lived down there at the time, and you know, a lot of people lost their jobs. Unemployment was high. A lot of people lost their homes, but the economy down there has bounced back, and that's one of the reasons why Texas is so strong right now, as opposed to states like California.
Well, that's kind of amazing. I guess just the Texas model, big bounce back from their crisis. America's economy not doing so well after we did bail out the financial industry, at least.
Right. We had 3.5 years of combination of bailouts and stimulus between the Bush administration and the Obama administration, and things have flatlined. And I mean, your editorial page is showing the recoveries in the early '80s versus now, and it's been a very weak recovery. And I think a lot of it is just they didn't want the banks to fail, and that really has had an adverse effect on the economy to inject new blood into the system, and also to get the lending started once the recovery does get going.
Makes sense. Thanks for joining us, Vern.
All right.
Appreciate it.
Again.